Step 1, assets and liabilities acquired. Share capital? 800. Retained earnings? No. Remember, we have to take retained earnings at acquisition date, which was given there in that paragraph. 120. Okay, retained earnings 120. We have to take everything at acquisition date. So share capital 800, retained earnings 120. Then there was a reval, a couple, The first one, land, up by 200. Is that right? Tax, CGT, how much? Times 28. Yeah, so it's 28 and 66.6. They will always tell you, so if you're not sure, if you look at the end of the question, you'll see that in point 9 they say what it is. Yeah. Okay, so share capital, retained earnings is the assets and liabilities as they stand. Then adjustments, increase land. Tax is always the opposite, hey? And then we're going to decrease inventory by 20. Is that right? And we're going to then have a deferred tax on that, which is 5.6, because it's a straight 28%. And then we're going to decrease receivables by 10. And we're going to have deferred tax of 2.8 the other way on that. And so we land up with step 1 being, just double check, 1061,104. Share capital 800, retained earnings 120, increase land, put in tax, decrease inventory, put in tax, decrease receivables, put in tax. Yeah? Okay. Then step 2 was the consideration. So there was some cash and there was some equipment. Is that right? 600 of cash and 110 of equipment, and there wasn't even an adjustment on the equipment because they said the fair value and the carrying amount were the same. But if it was different, we would always use fair value. Is that right? Okay, then step 3, we always have to look at the question. So if you look at the question, it tells you in number 7, FIG Group measures NCI at fair value at the date of acquisition, full goodwill method. So step 3 is NCI measured at fair value. So if we look, there were 200,000 shares. We bought 120. So they bought the other 80. Do you agree? 80,000 shares. And because we're going to use fair value, we're going to use the share price on the day of acquisition. The share price on the date of acquisition, they say to you in number 1, on acquisition date, the market value of one share was 540 a share. This goes a bit too manic, but do you agree that when a share price is trading on the exchange, it is the value of a minority share with no control, isn't it? Because it's the value of one individual share. The minute that you're buying any bigger amount of shares, there would be premiums. So there would be a premium for influence, for being able to stop a special resolution. There would be a premium for control. There would be, all of those would then be paid extra. So when we look at what the parent in this case is paying for 60% of the shares, it's going to be more than 5 Rand 40 a share, otherwise it doesn't make sense. Do you agree? Okay, so NCI is at fair value, because number 7 tells us that they measure NCI at fair value. It says they measure it at the fair value on the date of acquisition. So step 3 is 80,000 shares. They said to you that we bought 120, so there were 200 in total, so they are the other 80. And so NCI is 432,000, is that right? 432. Okay, now There is another NCI, so I don't know if that's where you're getting confused, but the other NCI is for preference shares. But we're not going to look at, we're going to look at them completely separately, isn't it? So for now, we're going to look at the goodwill for the ordinary shares, and then we'll look at the preference shares separate. So step 1, step 2, step 3, leaving us then with step 4, which is when we pull it all together, and step 4 should just be a pull together of what we've got. We start with 1061,104. We take off 432, which belongs to NCI, doesn't belong to us. That leaves us with what belongs to us, which is 629,104. We then look at what we paid. We paid 710. So then it leaves us with goodwill of 80896. And it is goodwill. We paid more than the assets and liabilities that we acquired, so we paid for goodwill. Yeah? And if you look at the solution, that is one of the options there. It is number 2. Is the option that we have for goodwill. Yeah? Okay. Okay, question 10 asks you what is NCI, but it doesn't ask you for NCI for ordinary shares. It asks you what is the NCI on acquisition date for the preference shares. For the preference shares. So have a look at that. Okay, so it says to you that you didn't buy any prefs, isn't it? So when we're looking at prefs, you didn't buy any prefs. So we have a situation, if I had to draw a picture, here's a company called Fig, here's the company called Olive, and there are 2 NCIs. There's the NCI for the odds, and they own 40% of the odds, and then there's an NCI for the prefs, and this NCI for the prefs owns 100% of the prefs. Yeah, and we own 60% of the odds. Question 10 asks you for this NCI. Now, something that's important to mention, and I didn't mention it before, is that you're allowed on a transaction by transaction basis to determine whether you're going to use percentage NAV or fair value. So you don't have to choose fair value for one and percentage NAV for the other. But in this question, they did say to you in number 7 that the FIG group measures non-controlling interests at fair value on acquisition date. And they mentioned to you in number 3 that FIG did not acquire any of the preference shares, that the preference shareholders have a preferential right to dividends and will receive only a return on their investment when they sell or on liquidation. And all preference dividends had been paid up to date. And they say to you that the fair value at that date was 110. So when we're looking at this one, NAV is 100, fair value is 110. So the difference being 10, which is goodwill. Yeah, do you agree? This difference over here of 10 is goodwill. Goodwill of 10. Now, because we elected to use fair value, then I think that this answer here would also be fair value, isn't it? Because when we show the NCI, we would join them. These two together represent the non-controlling interest, be it one party, many parties of Olive. So I would say that the answer for that one is then to reflect the NCI at 110. And so that answer there would also be number 2. Yeah. Okay. You'll see that the rest of the question is about consolidation. You'll see that if we carry on reading, paragraphs 4 and 5 is about intercompany transactions, intercompany sales of inventory, amounts between the companies, receivables and payables, and then they also talk about the sale of furniture from the one to the other. So there's some intercompany transactions. When you look at the requireds, the one required 2 asks you what will be revenue. Required 3 asks what will be disclosed as share capital. Required 4 asks what will be the impairment journal for the goodwill. Maybe we could actually answer number 3 and number 4, isn't it? Goodwill was tested and the directors determined it was impaired by 15,000. Okay, I think we can do that one, isn't it? So question 3 is share capital. That's fairly straightforward because share capital, as we know, is only ever the parent, isn't it? If you look at our picture over here, this becomes our new group over here, like that. These are our shareholders of our group. They are the shareholders of FIG, not the other shareholders. So when we're looking at the share capital, it's the share capital of the group, which is the share capital of FIG. So when you're looking at question 3, the amount that will be disclosed as share capital ordinary shares in FIG group, it will be the R1,000,000 for FIG. Do you agree? And that's fairly straightforward. So that's number 1. Question number 2 has some intercompany stuff that we need to figure out when we do the intercompany transactions. But we will be able to do question 4, which has to do with the impairment of goodwill. Remember, I talked to you about the impairment of goodwill. So what is the story with the impairment of goodwill? When we have NCI, and NCI is measured at, we had the 2 options, percentage NAV or fair value. When they are measured at fair value, then goodwill and goodwill impairment also belong to the NCI. Isn't it? So if you look at number 8, paragraph 8, it says, goodwill relating to the investment in Olive was tested for impairment. And the directors determined that goodwill was impaired by 15,000 Rand. So there's this impairment of goodwill. So we need to put a journal in for the impairment of goodwill. Do you agree? So where does the impairment go? It goes to goodwill as a credit. Yeah, and the debit side goes into our P&L. And then this P&L needs to be split between FIG and the NCI. And the split happens in proportion, 60-40. So have a look at those journals, see if you see one that you think makes sense. You think 5? Okay. What happens is in our P&L? Do we only put our share into our P&L, or do we put everything in and then give NCI their share? If you think about a consolidation. Consolidation, we control. We bring in everything, isn't it? We control, we bring in everything, even though it's not all ours. Then we say, we brought in everything, but some of it's not ours. Okay, so if you think of it that way, Journal 2 says, your initial journal, which is to debit the P&L and credit goodwill with 15,000, has to be full 15. Everything must come in, isn't it? So that means that it can't be 3, it can't be 4, it can't be 5. Do you agree? The initial journal has to be a debit to expenses of 15 and a credit to goodwill. Goodwill has to reduce by 15. Then, because it's at fair value, because NCI is at fair value, they get a share of that goodwill impairment. Their share is 40%. So what is 40% of 15? Is it 6? So then we're going to give them a share. So what we will do is we will say, here's some expenses for you. Their financial position balance drops because we're giving them expenses, not income, isn't it? So, and our P&L charge, our hit becomes smaller. So we will credit NCI in the P&L to reduce our hit, and we will debit NCI in the balance sheet. So that answer is 2. Okay, so always remember that when we do the impairment, and I said to you NCI gets some of the impairment, the actual impairment will still go through. When I say the NCI gets or doesn't get, it's when we're working out NCI's share of profit. When we're working out NCI's share of profit, if it's at fair value, we would include the goodwill impairment and reduce profit by that amount. If it's not, then we wouldn't. Then the parent would take the full hit. Okay. All right, so as I said, number 2 is about revenue, and I see there's some intercompany sales of inventory that will affect the revenue number. Question 5 is about dividends that were paid. Maybe we can have a look at question 5. Dividends that were paid by the one or the other. No, we can maybe come back to these. This isn't really IFRS 3. We'll come back to these. Dividends paid is number 5. Number 6 is PPE, cash and cash equivalents. Number 7. Number 8, mark-to-market reserve. That's what we were talking about, what I was going to touch on earlier, but I think I will discuss it next week rather. And number 9 is payables. Again, it's all about intercompanies and how it affects those balances. Yeah, so we'll look at that next week. So 10 we've done. So then written assignment 2. You'll see that assignment 2 has is a bigger group structure. It has a parent. It has, I think it's a subsidiary and some joint control. When you read the additional information, you'll see that it says on 1 January, AB acquired 30,000 shares and exercised joint control. Do you see? So that's a joint arrangement. Number 3 says AB acquired shares of Sangha. In terms of a contractual agreement, they exercise joint control. Do you see that one's also joint control? So Tendu is joint control, Sangha is joint control. Then number 4 and 5 is where we have a subsidiary. So 4 says on 1 September, AB acquired control of Raba by acquiring an 80% interest in the issued ordinary share capital at 600,000 Rand. At this date, the fair values were all equal to carrying amounts, and on 1 September, the equity consisted of share capital and retained earnings. And they've given you an extract of the trial balance as at December. Okay. Only because they haven't given it to you in the additional information that was given in the front. And I presume they're going to ask not for a statement of financial position. Yeah, they don't. They ask for a P&L because we don't have the assets and liabilities of the sub, so we wouldn't be able to prepare a statement of financial position. But I see they only ask for a P&L and a statement of changes in equity. All right, so for now, it's just that number 4, doing a quick ONAC, just to keep, yeah, for when we might find a bargain. If we do, it might affect our P&L because it looks like it's in the current year that we did this acquisition. Do you see? If you look at the year end, it's December 15, and the acquisition was 1 September 15. So if there's a bargain there, that would land up in our P&L. So let's just look there. And then we always must look to see how they're measuring NCI And if you look at number 13, it says they measure NCI at proportionate net assets value, partial goodwill. So no fair value on this one, partial. And you'll see one will be one will be the other. It will just be something that you will get very used to going to look before you start, because otherwise, or when you get there to step 3, because you can't guess or assume. Oh, the other thing. Oh, they've given us retained earnings. The other thing is that this acquisition is halfway through the year or 3/4 of the way through the year, isn't it? Remember last year in second year when we had those, you had to split the profits. You had to do that apportioning. Do you remember? But they did give you retained earnings at that date. So you don't actually have to go and do any work. Okay. Well, not for now. When we do the P&L, we'll probably will have to, because then they've given us information for the full year. All right, let's see what comes of this one. I'm going to do it so long, and then we can compare. Instead of doing it on paper, I'll do it on the board. And we do, in fact, land up with a bargain, right?
Because they gave us retained earnings on the date of acquisition, that reval has already been, because it says the other comprehensive income includes a reval of equipment. So does that mean it's been taken into account?
Good question. The reval happened only at year end, luckily. Yeah. Otherwise, there would have been a mark-to-market if it was before. Yeah, I didn't even notice that, I must admit. But yeah, when you look at it, there was an OCI for a reval. I don't know why they call it a fair value adjustment on equipment, because that's a reval. Other comprehensive income relates to the reval on 31 December. So as at the acquisition date, there was no reval, and they do say to you in number 4 that at this date, the fair values of assets and liabilities were equal to their carrying amounts. And they don't say anything to you in there about a reval surplus. But yeah, good point. If it had happened before, we would have had to put it in as a reval surplus. It's part of your equity, isn't it? And it would make that number bigger. Yeah, it would make that number bigger. Okay. I haven't read anything else, but obviously in this group structure, and remember I had said to you that in third year our group structures are bigger, isn't it? Second year I think we just had parent sub, and I already made you draw the picture, hey, but now it becomes even more important, because if you look at this one, we have A, B, and then we have 3 companies that look like that, all sticking out from AB. Is that right? Yes, it is. We have a T, an S, and an R. And we need to, for each one, understand what type of control there is or influence there is, and therefore how are we going to account for it, when was it acquired, how much did we acquire, where are the NCIs, etc. But we won't be able to complete this for quite a few weeks, because as I said to you when we started, next week now we're going to go back and look at consolidations, and then we will be able to finish assignment 1, because assignment 1, it looks like a fairly simple, straight consolidation. Then in week 3 we're going to look at vertical groups, which is can be a bit challenging. And then week 4, associates, and only week 5, we're going to get to joint ventures. So when we then get to joint ventures, I think they say it's a joint venture. It's a joint venture and a joint operation. So we have one of each. So when we get to week 5, then we'll be able to finish this one. But I think the assignment dates usually for assignment 2 are late, 13th of April. So we have lots of time. Assignment 1... we also have lots of time, but we should be able to finish assignment 1 next week, because there are no associates, no joint operations, no changes in ownership, nothing else in assignment 1. So it's just, in fact, you probably find that if you wanted to try and do it from second year knowledge, you could, yeah, because the rest of it is just, the only thing that you'll see next week which we'll cover is that when we did intercompany adjustments in second year, we didn't look at tax, and now we will. Okay, so unfortunately it's a blessing in second year when we don't know about tax and deferred tax, because we just ignore tax. But once you know about it, everything you look at in third year, you look at tax. So we will be looking at the tax implications of the intercompany adjustments, and those will obviously impact your profit numbers, because the number will be the net of tax. Okay, so that's IFRS 3. The only other way that I can think IFRS 3 could be examined is as a little discussion question. But probably not, probably most likely just the beginning of a consolidation question will be a IFRS 3 bit. It might be more complicated like it was in assignment 1, or it might be straightforward like it was in assignment 2. You just never know. Okay. All right.